If you're planning on purchasing a new car and you run a business, I'm sure the question of how can I actually claim this through the business has crossed your mind. In today's video, I'm going to talk all things claiming cars through your business. And before the video is done, I'm going to talk to you about the new car trap that people fall into. So make sure you stick around for that part. Now, the first thing that we need to work out is the car actually being used for the business, and therefore how much? So the simplest thing to do is to do a logbook, which is what you're going to probably have to do anyway if you want to maximize your tax claim. So you do the 12-week logbook. Now, obviously you can't start this until you get the new car, but you could do it on your existing car if you haven't done one in a while, or just get a rough estimate. So you start to have an idea of how much of this car am I actually going to claim. Now, we're going to go through some examples here to show you the different ways you can claim the car and how different prices of the car will impact that. Now, in these examples, we're actually going to assume that the car is being used 100% for business purposes, but if you weren't using it for 100% for business purposes, you may need to adjust and do some different calculations. So let's look at three different cars here. So car A was worth $15,000, car B was worth $50,000, and car C is worth $100,000. Now, we are assuming for all of these vehicles that there is 100% business usage and that those prices are net of GST. We'll talk about GST later on in this video. So let's go through each one, how we claim it, how much tax we're going to get claimed in year one, and how much tax savings we're going to have across the whole lifetime of that vehicle. Let's start with the $15,000 car. Now this one, the way the current rules work, we're about to use the instant asset write-off because it's under $20,000. So this means in year one, we're going to be claiming the full $15,000. Now we're assuming that we're a sole trader with $120,000 of taxable income for all of these vehicles. So in this situation, our tax rate is going to be the 32%. So therefore, we're going to claim $15,000 at the 32%. We're going to have $4,800 of tax savings in year one. And that will obviously be the total lifetime savings as well of $4,800. Now let's move on to the $50,000 car. Now this is greater than the instant asset write-off limit. So what we have to do with this one is what we call the small business pool. So the asset gets pooled. Now the small business pool has lots of different assets in it, but the assets that get pooled in the first year get claimed at 15%, and the remaining balance gets claimed at 30% each year afterwards. So in this sample, we've got the $50,000, it's getting put into the pool, and we're getting 15% of that in the first year as the claim. So the first year's claim is going to be $7,500, and at our 32% tax rate, we're going to have $2,400 of savings in year one. Now across the lifetime, we're going to claim that full $50,000, and we're going to have $16,000 of tax savings for this vehicle. So you can see quite a difference in the total savings, but in year one, car A actually had a higher tax claim, even though it was worth much less. Now let's look at car C. This one's worth $100,000. So again, it's over the instant asset write-off limit, but the catch with this one, it's also over the car limit. So there is a limit for how much you can claim for a regular car, and that limit for the 24/25 year was $69,674. So this is the only amount that will be pulled, not the full $100,000. So we now look at this same method as car B, where we do the 15% of that in year one. So our claim in year one is going to be $10,451.10 or $3,344.35 in tax. And across the whole lifetime of the car, it's going to be $22,295.68. So even though we had three very different prices, our tax claim was actually higher in year one for car A than it was for car C, even though one was worth 15 grand, one's worth 100 grand. And that's just due to the different methods that are in place depending on the price of the car. Now, before I talk about GST, FBT, and selling the vehicle, I'd love for you to join my free newsletter. I send out this newsletter every single week with tax tips for you guys to help you better understand tax and hopefully save you a few dollars along the way. I'd love for you to join. The link is in the description to this video. Now let's talk about GST, FBT, and selling. Now I'm not going to go into any of these topics too deep, but I just want to briefly touch on them because they are important and they are important topics for you to continue to research after you've watched this video. So GST is something that you definitely want to understand when it comes to vehicles. Is if you've registered for GST and you buy a car and it has GST, so typically you've purchased through a dealer or another GST registered business, then you'll likely be able to claim that GST. Now there is a GST limit, so the GST limit for FY 24-25 was currently $6,334. So again, that's the maximum you can claim, a bit like the car limit. But if you go and buy that vehicle and that $50,000 vehicle had $5,000 of GST on it, then you'd be claiming that GST back. Now, obviously you need to be careful when you do sell the vehicle because there could be GST that you now need to owe on that vehicle. The second one was FBT that I mentioned there. So this is fringe benefits tax. So if you're an employee of your business and you're using the vehicle privately, or it's even being stored privately, then there's likely going to be FBT implications. FBT is a very complex area of tax, and you definitely need to get advice on this and understand it very thoroughly, because especially if the vehicle is going to be used for quite a large private portion, this could cost you a lot of money. And then when you sell the vehicle, there is going to be tax implications. So if you sell the vehicle that you've claimed on the business, then you're likely going to need to include that as a sale of an asset. And depending on how much it's claimed and how it's being claimed will depend on how it works. There's likely going to be income tax and GST obligations that you're going to have to be aware of and need to factor in, especially if you're not buying another vehicle as a trade-in at that time. Now, it doesn't actually matter whether the car is new or used in a lot of these examples, but obviously there could be GST on it or not GST, so that is something you need to remember. Now, I did promise at the start of the video I'd mention the new car trap. And I'm actually not talking about getting a brand new vehicle. I'm just talking about a vehicle that is new to you. So it could be new, could be used. What people do is sometimes they think, I have to get a new vehicle just for tax purposes. And it's a big area where people cost themselves a lot of money, but think they're doing well, but maybe they're not doing so quite well. So let's look at that $100,000 car. Now, after the tax savings, it's still costing you $77,704.32. And this could be even higher if you're paying interest on a loan. So if you'd convince yourself, I need to get this car just for tax purposes, the tax purposes weren't really enough for it to reduce the cost. You've still paid a lot of money for that vehicle. Now, we compare that to that $15,000 car. The car only cost us $10,200 total after our tax savings. So we're talking a nearly $70,000 difference between these two vehicles. So it's something that you do want to consider is, am I doing this because I actually need the car, actually want the car, or am I just doing it because I think it's going to save me tax? Like anything when it comes to tax, is typically don't spend money you weren't going to spend already, because you're going to be worse off because the tax rates are lower than 100%, so therefore it's still going to cost you money out of pocket. Now, all of these calculations I've talked about would look very different if you're using a company, and it might be a good time as we get closer to the end of the financial year that you ask yourself, should I be a sole trader or a company? In this upcoming video, I go through the key differences between these two common structures in Australia, talk about which one might be best for your situation. I look forward to seeing you over there.